Welcome to TheoTrade. This is Don Kaufman, March 9th, 2020. Clearly, this is a trading session that many of you are going to remember for your entire investing and or trading career. Massive move to the downside. We have 2 minutes to go to the cash close. And yeah, you're looking at that right. The S&Ps are now down over 7%. Okay, a 213-point move inside of the S&P futures. But before I dig into any of this, in tonight's video, I want to be very, very specific as to why I believe this crash is just far too quiet. Now, for those of you that have been around some time inside of this business, maybe you've been through some fairly hideous trading sessions, and there's no question that this one is right up there. I mean, the Dow is going to close down almost 2,000 points. One of the largest point moves. It is the largest point move, but this is about percentages. This is about magnitude, okay? This is what we would construe a crash. But again, I'm going to give you some highly detailed points that you really got to kind of tune into of why this crash, again, is far too complacent, far too quiet. Let's start. Let's start actually with what we term expected move as we come into the bell on this epic trading session. So I'm actually going to start here in the SPX. For those of you that do tune in kind of week in and week out, the SPX, kind of call it the mother of all option products. And I'm going to detail here for just a second. The SPX, it only had, okay, well, $162 move. And right now the SPX is moving $220. So we are outside the expected move on the week. And again, coming into the closing bell right now. S&P is flushing out the close over there, okay, down to the tune of almost 8%. The point that I'm making with this, all right, and I'm being a little bit facetious possibly, which is probably not something you want to hear on a day that the S&Ps are down, what, 8%. Listen, there was an expected move of plus or minus $162. And you're looking at this move and you're saying, but Don, it was unprecedented. But Don, okay, we had a $162 expected move. What did you think was going to happen this week? You think this was going to not be Mr. Toad's wild ride? We were expecting a wild ride. Okay, just because it's outside the expected move right now doesn't necessarily mean it ain't going to come back in. So we were expecting a big move, and well, we got a big move. Now, if you look at the SPX, okay, and again, this cash close got a little bit wild, and you can see there's still some follow through into it right now. But if you look at the cash close for the remainder of the week, and I'm telling you, you need to do this stuff, okay? You need to do this stuff. Take a look right here. We're expecting still another $190 move, okay? So I wanted to start with expected move to give you a feel of, first of all, what was anticipated and what's really unfolded. And the two are not that far off, right? We're expecting a $160 move, and right now we've had a $226 move. So, okay, we're outside it. I got it. But now, moving forward, the expected move is still in hideous territory. Okay, let's move past that. Next, low volume in the S&Ps. Here, this is one of the things that was striking all throughout the course of the session. Now, if you tune in to the untrained eye, they're going to look at the S&Ps and they're going to say things like, well, the marketplace overnight was lock limit down. For those of you, let's actually tune into the intraday chart here for a second. If you're unfamiliar with this terminology of what we term lock limit down, let me actually show you exactly what a lock limit looks like right there. Okay, what lock limit down means is overnight, okay, you're set to stop trade at a 5% move. So we actually go limit down. Limit down would allow you to be a buyer, okay, but you can't be a seller. So if you want to come down here and you want to buy when we're limit down, that's fine, but you can't go through the 5% threshold. All 5% thresholds are set on the previous trading session's close. Then when the cash market goes off, the bell goes off, that limit drops to 7%. Well, you know what? We hit that 7%. It was right down in here. The second we hit the 7%, boom, lock them down. They locked them down for 15 minutes. Now, that's a part that you don't necessarily see reflected inside of the chart. But if you zoom in very, very tightly, okay, the time sequence, it's all kinds of off. You're like 6:35, boom, then 649. There's actually right here, they locked him up, like they just locked him down. 15-minute halt on all trade. Okay, so now we're getting somewhere. So why am I talking about low volume in the S&Ps? Well, first and foremost, the volume. This is now end of day volume. The volume in the S&Ps here is doing about 2.4 million contracts. Now, of course, you could look out to multiple months. There's a little bit of volume out here, 102 days out. Don't get ahead of yourself because that's nothing. 2.4 million contracts. Now, granted, I realize that the S&Ps didn't trade much overnight. Again, the S&Ps didn't trade much overnight. But even if that accounted for 1 million contracts, here's the point that I am trying to make. Okay, and it should be a very bothersome point. Don't even bother looking at the chart. All you need to look at right now is right here. All you need to look at, okay, so we did 2.5 million contracts. We should have been doing 5 million, minimum. We should have been doing 5 million S&P contracts, absolute bare minimum. I mean, what? We did, 5.5 million 2 weeks ago when we actually had that first burst to the downside and reversed off of it. So where's the volume? Okay, I want to know, where's the volume in the marketplace? Because I tell you what, I have been through, okay, some pretty serious days in the marketplace. And by the way, I don't wear that like a badge of honor. I really don't. But over 15 years, I've been through some pretty serious trading sessions. This one, it's nothing. The move was big. The percentage move was big. Okay. But the volume is absolutely nothing. And I fear that. Now, if I was just looking at volume and volume alone, and it's nowhere to be found. In fact, when I started looking at the SPX, the mother of all option contracts, it cruised down to the SPX. I actually opened up option statistics. You know, the SPX today, let's take a quick glance, which is like one of the biggest products out there. 2.2 million contracts. That did 1.3. Okay, this is what we call sizzle index. This is 1.3 times, okay, the norm. What's the norm? The norm is versus the previous 5 trading sessions. That's what sizzle index actually means. Okay, on the thinkorswim platform, it's today's option volume versus the previous 5-day option volume. Okay, I know that because, well, I worked there, and this is actually one of the pieces of logic that I created was 5 trading sessions. So in this particular case, doing 2.2 million contracts, it's completely anemic. There's no volume. All right, I looked at the spiders. Okay, the spiders are kind of rocking, right? But just the other day, I saw much more than this, right? So 6.5. Again, everywhere you look, the volume, it ain't right. It's just not right. So low volume in the S&Ps, low volume in the options. The next thing I want to point out, and I'm going to come back to the S&Ps for this, okay? And this one really bothered me. The markets, specifically the S&Ps, adhered precisely to specific gravity points and never broke loose. If we are in, okay, an outright, utter, and hideous crash, I got to ask you something, okay? And I've given you guys these gravity points well before today. I've been talking about these gravity points for years. How could we possibly be bouncing and adhering? Do you realize, okay, in one of the most volatile sessions in recent market history, look at the S&Ps right now, okay? They're spot on a gravity point. Now, this gravity point is 27.31. Up above over here, okay, is 28.11. They didn't only adhere to it. You realize, okay, they literally, it was spot on to the tick. And you're going to tell me right now, market's capitulating. It's doing this, it's doing that, okay? I'm not going to buy it. When markets break apart, they don't adhere, okay, to finite levels. When markets break apart, they don't have low volume. Next over here, and this is going to get a little bit more wild, the Russell, okay, diverged lower than the S&Ps and the Nasdaq. So for this, I'm actually going to move into a comparison chart. So I'm actually going to bring up the QQQ, okay? So I'm going to bring up the Qs. And the Qs here, look, on a year-to-date basis, the Qs are now down 10%. They were up almost 10%. Now they're down 10%. So we're almost in. We're in the bleeding edge of bear market territory. By the way, if you're kind of curious about this, the Russell, full-blown bear market territory. They were up about 2% of the year. They're now down 21%. Absolutely got crushed into today's close. But the point that I want to make with the QQQs, I'm actually going to go to style. I'm going to go load style, and I've got a pre-formatted style. What you're looking at right now, right here, this is the QQQ versus the IWM, okay, versus the spiders. In fact, I'll even open up to a full screen to make a brief but critical point. So IWM, spiders, okay, and of course the Qs. There's the Qs, that's your primary product, okay, right over here in the middle of the spiders, and then down below here happens to be none other than the Russell. This is year-to-date performance, okay, 21%, basically 15%, and 10%. In the midst of an all-out blitz to the downside in a marketplace, we should actually see convergence of the indices. We didn't today. They actually diverged even further, okay? What that basically means, and again, I can go back to, 5-year time periods. I can go back, 20 years. You want to look at major indices. Major indices are supposed to converge. Major indices are supposed to converge upon extreme volatility. In effect, what I'm saying is how we move, okay? These things should be moving in almost perfect relative tandem, and they're not. I mean, come on. You have the Russell here down 9%. The S&Ps are down 7.5%. The Nasdaq kind of outperform. They should be converging upon one another. I mean, all of these factors, okay? All right, so you got the S&Ps. They didn't move that much outside of expected. There's low volume in the S&Ps. I mean, I could dub this the quiet sell-off, right? The quiet crash. I think that's actually probably the right term. Dub this now the quiet crash. Markets adhering to specific gravity points, but the Russell diverging. Okay. Now, financials got decimated, but that's to be expected with the bonds, on the move, the way that the bonds have been moving. Nevertheless, okay, I want to actually now bring up the financials for a second because they absolutely did. They got decimated. But if you remember in this weekend's video, I talked about the 2650 level. And once the financials are under the 2650 level, which they absolutely were on Friday, I said all bets are off. They're probably going to crush the S&Ps. And this is exactly what we're seeing. Now, there's not too much I want to cover, all right, on the financials, other than they've been decimated. The problem that I've got at this point is some of the other sectors, like monsters of tech, have thus far fared very, very well. Okay, and this is, again, it's disconcerting to see a marketplace that's unwinding. But number one, unwinding in an orderly fashion. Number two, unwinding on low volume. Number three, unwinding with, again, without convergence in there. It's all kinds of wrong. Get that through your head. All kinds of wrong right now when the financials are getting decimated, but at the exact same time, and there's a reason the financials are getting decimated, but at the exact same time, you're going to tell me, okay, that Microsoft is a life raft, right? That Microsoft's only down 6% on a year-to-date basis, but all of a sudden you snap it to a one-year chart, Microsoft's up 33%. Go take a look at Apple, unscathed, up 50% over the last year. You have to look at this and start to fathom it may only be the beginning. This, okay, is going to be a little bit nerve-wracking in the days to come because I'm going to tell you right now, I'm like almost looking at the S&Ps. I'm expecting the administration to come out and do something. I'm expecting the Fed. I'm expecting a pop back to the upside. But I don't think we're going to buy into it. I think that every move to the upside from this point forward until we actually have a definitive break apart in the marketplace, I think we're going to sell into this. We are no longer in a marketplace that you might remember, okay? We are coming apart, but this is a process, and this process is going to take time. And that's what you have got to get in your head, because I've got right now 100 emails sitting in front of me. Should I now buy? Should I now buy? And I say to you, what is this? We're now the third week. We're not even to like the full third week, but we're just in the cusp of a third week of some sell side activity and people asking me if they should buy. The last chart I want to give you tonight, let's actually look at a quick glance at a 5-year, just a 5-year inside of the spiders. A little bit of damage done? Absolutely. Okay, but net, unscathed. You start opening up more substantial time frames, yeah, you can see the move that we've had over here. But net, unscathed. Think about that in the days to come. Again, I'm expecting that bounce as much as you are, but at this point in time, I believe we have to literally come apart at the seams. We have to see capitulation. We have to see explosive volume. We have to see convergence before any of this is over. Have a great evening, everybody. Bye-bye.